All right, let's talk more about what the CPI data means for the larger market. Will Compernolle is joining us now, FHN Financial Macro Strategist. Will, how are you viewing the data that we got this morning, and what does it tell us about how sticky inflation is at this point?
Well, good morning. Thanks for having me. I think the kind of disappointing answer to what does this inflation report show is that there's nothing new. It's really a repeat from the last few months, which is that core services ex shelter, what the Fed likes to call it super core inflation, when all of the noise from supply chains normalizing and food and energy kind of zero out what they consider underlying inflation, the momentum is still too high. And so that is how the Fed is viewing inflation. Now, just to put into a larger context, that headline inflation going down from 6% to 5% year on year, it's important to remember that that is compared to March of last year. So that's right when global commodity prices spiked following the Russian invasion of Ukraine, which means that that spike is essentially priced out of year over year comparisons, the so-called base effect. So it looks good. It's a percentage point improvement. But really what the Fed is looking at is the momentum. And when you look at month over month momentum of the super core, the three-month change annualized, then it's too sticky. So I think, when we look at expectations for the May meeting and onward, this CPI report might really not add too much. I think the PCE inflation data, which comes out, I believe, April 28th, a few days before the FOMC meeting, that will really set the tone. Of course, even later today, we get the FOMC minutes, we get retail sales spending, retail sales on Friday. So there's a lot more potential to shift expectations after this report.
I've been kind of trying to get a pulse on how many months makes a trend for the Fed here, and when that kind of puts us in, at least on this kind of calendar year basis, when that puts us within the throes of them having a conversation about any type of pause or even a pivot if the data continues to come in suggesting that things are slowing.
Well, I think the Fed right now is really operating from a point where they want to not repeat the mistakes of the late 70s, early 80s, where monetary policy kind of eased up on tightening a little prematurely. And it meant that they had to inflict more pain through more aggressive interest rate hikes and not really going back to square one, but certainly they kind of increased the work they had cut out for them. So I think the burden of proof is really on inflation slowing down. So you can kind of nitpick and look at the nuances of any inflation data to say, well, things are improving. But there are two things to keep in mind. The first is an improvement from the highest inflation in 40 years is still too high. So we've got to get monthly increases back to 0.2%. That's consistent with the Fed's longer term 2% year on year inflation target. But then also, the kind of persistence of those improvements really needs to convince the Fed that these aren't kind of one-off blips, because there's a lot of noise in the economy right now, as there has been in the last few years. So, I think to answer your question, there's not really a certain number of months that dictate a trend, but inflation is still too high, even when we can look at certain aspects that are improving.
So all of that paints a pretty uncertain picture continuing. Well, so what do you do from a strategy point of view, given all of the unknowns?
Well, I think, let's go back to the Fed's March meeting. So in Chair Powell's press conference, what he said in so many words was that built into the Fed's 5.125% end 2023 dot for the projections for Fed funds was an assumption of some credit tightening from kind of the bank tensions that we've seen over the last couple of months, or I guess now month. So that is really the important thing that the Fed is watching. And I think that's going to play out not over the next few weeks before the May meeting, but over the next few months. So in that sense, the May meeting could have a 25 basis point hike if inflation really is unambiguously kind of driving the Fed to prioritize that. But really, there will be more clarity, I think, by the June meeting, where we'll have, first quarter bank earnings calls in our pocket to really see how banks have adapted to this atmosphere. we'll have a few more months of spending and inflation data to see to what extent the economy may be overheating. So, the real answer is that in the next month, I think we still are seeing a lot of uncertainty. And hopefully by the summer, things will be a little bit more clear.
So since you mentioned the banks, and as we kick off the earnings season and are expecting to hear from the large banks and then start to get into some of the more perhaps impacted or at least sitting on the edge of their chairs, regional banks as well right now, what do you believe in the tenor that we hear from them the Fed could or should pay closest attention to, even despite us knowing that the Fed looks at the economic data, looks at some of the lagging data? There have been calls for the Fed to look at or at least consider more forward-looking data. So what is it that they can pay attention to with some of those banks?
I think it's a really tough call. The monetary policy famously operates with a long and variable lag when it comes to inflation. But I think evaluating tightening financial conditions, what it means for bank credit is even more of a moving target. So I think they're going to rely on their bank contacts. Remember that these 12 regional Fed banks are really in close contact with local banks that are, deciding whether to tighten financial conditions. Now, I think that will be more of kind of a harbinger than the actual data, because even when banks decide, okay, we're going to kind of increase lending standards, we're gonna cut back on some loans. Well, that happens with its own lagged impact, and then of course, when that shows up, it's reported with a lag in the data. So I think the Fed is really going to lean on its bank contacts to see, do they need to pause in May because credit is contracting too much, or can they kind of incrementally go about fighting inflation?
Will Compernolle, who is the FHN Financial Macro Strategist, thanks so much for joining us here this morning.